Hi, this is Jim Welsh from macrotides.com. Thanks for taking the time to listen to this podcast. I'm going to discuss contrary opinion, and I'm going to tell you that it is one of the most powerful investment tools that every investor needs to cultivate and learn. And we're going to do this by looking at Treasury bonds. As the chart shows, the yield on the 10-year Treasury has dropped from 3.25% back in early October down to 2.45 here on May 7th. So the trend in lower interest rates has been going on for about 7 months, a trend that is well entrenched. Investors believe the Federal Reserve is likely to cut the federal funds rate before the end of 2019. This view is being supported by the IMF lowering global GDP estimates. The U.S. GDP is expected to slow as the fiscal stimulus wanes, and finally inflation has been less than the Fed's 2% target, which gives the Fed, if you will, the opportunity to lower interest rates. So, contrary opinion, it's one of the most powerful investment tools, but it's really difficult because what one needs to do is go against a trend that has been in place for many, many months, sometimes more than a year, and go against all the reasons why a market has been moving up. There are a couple things one has to use to understand when contrary opinion is appropriate. One is sentiment. Typically, you'll see widespread bullishness or bearishness. So, for instance, in February of this year, when gold was trading around $1,340, bullish sentiment was up to 90%. We subsequently saw gold decline from $1,347 to under $1,300. The other is positioning. So when people are bullish or bearish, they're going to establish positions with their money. And when you reach an extreme, everyone who could bought is pretty much has bought, and there's not much buying power to fuel a market higher. Conversely, at market lows, everyone knows all the bad news. They can't take it anymore. They sell. That's what causes the low. So let's look at Treasury positioning. According to J.P. Morgan, institutional investors have the largest long position since mid-2016. Everybody who just about could buy has probably already gone in. Now, let's look what happened. And we're going to do this by looking at the Treasury ETF TLT. In mid-2016, TLT was trading above 143. 6 months later, it was under 117. It dropped 18%. What causes contrary opinion to work is when you have so many people long a position, in this case Treasury bonds, and it begins to go against them, and they begin to incur losses, sooner or later people cut losses by selling, which causes the prices to decline. Now, the goal here is when can we identify the next turn in the bond market? I just noted that positioning is extreme as it has been since July of 2016. Back in 2016, you can see from the 117 area, TLT rallied for about 8 months to a high in early September at 129. If we add 8 months to the low on October 5th, we get early June. So time-wise, early June could be pretty interesting. All right. Secondly, looking at momentum. The RSI recently, about a month ago, when TLT rallied up to 126 and change, if you look at the bottom portion, you can see the RSI diverged. I think over the next 2 to 3 weeks or so, bond yields have the potential of coming down more into the early part of June. TLT has the potential of rallying above 126, and there's a good chance if it does, the RSI will diverge and provide a negative technical signal. So you need a combination of contrary opinion, so many people are bullish or bearish, and then use technical indicators to identify the exact timing or, get in the ballpark of when a market is about to reverse positioning. Hope you found this of interest. If you want to learn more, check out macrotides.com. May good things happen for you today.